Well, I want to say good evening to those of you that have already logged on to our webinar tonight. We still have people that are getting on, so I'm going to come back in about 2 minutes, and we're just going to give just a little more time to the people that are getting on right now, and then we'll go ahead and start. So I will be right back. We're still waiting for just a few more to log on. And I'm going to give it 1 more minute and then we'll start. But again, we're still having quite a few that are just getting on right now. So I'll be back in about a minute. All right, so I think we're going to go ahead and get started. We still have people logging on, and we're estimating right now we're a little under 200 people, and I'm watching the number. It's still climbing, but we're going to go ahead and get started. And I want to welcome just all of you that have taken the time to tune in tonight. This is a client-only webinar, so about 95% of you are clients, from what I understand. And we're going to be going through, first of all, talking a little bit about, how our model did last year, what happened to the stock market, the bond market, and the economy. And we're going to give you some really reliable information, folks, on where we believe we're going, not just over the whole of 2023, but even this quarter. And so the first thing that I want to do is start by giving you the status of our model, our 3 buy sell signals. And the way to think about it, folks, is first of all, the first thing I want to do is tell you last year, our model pretty much had us out of the bond market from January on. In other words, our bond signal warned us to get out of the bond market in January. My short response to that is hallelujah, because if some of you know, it turned out to be the worst drop in bonds in American history. It was a bloodbath, and I'm going to show you, more about that shortly. And we were out of the stock market for most of the year. We did go back in, partially a couple of times. But most of our models, folks, to put this in perspective, we track our models against a Morningstar recommended portfolio with the same amount in stock and the same amount in bonds. So for example, our very popular 60-40 model, which is 60% stock, 40% in bonds, we have more than one version of it. But most of our clients were down anywhere from maybe 10 to 13 or 14%. Some were, a little higher, a little lower, depending on exactly what they were doing in their portfolio. But the Morningstar model with 60% stock and 40% bonds was down 17%. And many people, as some of you know from some of your money you've had other places, were down a lot more than that. Many people that were coming in last year talking to me were down 18, 19, 20, 25% because they were really over concentrated in certain tech stocks, which did not do very well. And the other thing I want to remind you folks, and I'm going to come back to this a little later on, but where we moved last year were into short-term treasury bills and in a money market mutual fund that actually was made up mostly of treasury bills. And what I'm telling you, one of our research partners that we get a lot of our information from, this is what the head of this research firm said. That was in 2022, there was no place to hide. The stock market went down. At one point, the S&P 500 was down 24% last year. It ended the year down 19.4%. The bonds also went down, which is highly unusual. And even gold was negative. And of course, cryptocurrency got slaughtered. So as he pointed out, there was no place to hide unless you were in short-term T-bills and other things similar to that. And guess what, folks? That's exactly where we were. And by the way, one thing I discovered, when we tell people we were in T-bills or short-term types of cash positions, we started realizing a lot of people thought, wait a minute, Mike's got me sitting in cash, not making any money. Well, folks, just so you know, these T-bills and T-bill equivalents we're in are making about 4%. Okay, so I'm learning not everybody knows that. So you are making, right now these instruments we're in are making 4%. But even more important than that, folks, they didn't go down near as bad as, the stock and bond market, which is what most people were in all year long. And so the important thing I'm telling you, last year we stepped to the side. And so what that means is this, folks, if this gets worse, which I'm going to tell you why I'm very confident it will, we're not going to go down because we're out. In other words, out of the stock market. Now we're still making money, but we're not in the stock market and we're not in long-term bond market. But if the buy and hold models, if the people that are in a typical buy and hold model, they have no protection. If this gets worse, they're just going to, keep going down. So, and also, and I'm going to get to this a little later on, we see a tremendous buying opportunity, which is how our model works. The last time we had an opportunity like this was probably in this model was in '08. But historically, these models do their best work in a severe market drop because in other words, we don't get out at the perfect top. Nobody does. But the key is we've stepped to the side. We did a lot better than the buy and hold models. And we see a tremendous buying opportunity coming up, not just on the stocks when they get near their lowest bottom, but the other opportunity, which I haven't seen in decades, folks, is a buying opportunity on the bond side because we completely missed the drop in bonds. And our signals are showing that that is getting closer to where we may possibly be going back in on the bond side, although there could be the possibility, at least according to our research, of maybe going down a little more. Because remember, folks, interest rates up, bond prices down, right? Some of you know that, it's kind of how it works. And I'm getting a little bit ahead of myself. But again, as we're speaking right now, all three of our stock signals are negative. Now, there were some times last year they went positive, partially positive, very briefly, and then went back out again. And our bond signal is also currently negative, and has been since January, not this month, but it's been negative since January of last year. And again, that was just a great call because the bond market, as I'm going to show you, just got slaughtered last year. Okay, so I want to recap now 2022, just to kind of show you what really was going on, folks. Now, while the S&P 500 ended the year down 19.4%. But there was a time during the year where it fell 24%. In other words, it fell into a solid bear market and then bounced back up a little bit, which is very typical in a market crash to have, these false rallies. But as you can see on the graph, the NASDAQ, they sometimes call that the tech index. It's not really all tech, but it's got a lot of tech in it. It ended the year last year down 33.1%. And the FANG stocks, FANGs means Facebook, Amazon, Netflix, and Google. If you put the same amount of money in those four stocks, last year you lost almost half your money. It was down 48.8%. So 2022 did not reward people who took big risk by over concentrating in any of these big tech stocks like Amazon or Google. So that's one thing I want you to know. But now, folks, here's something else I want you to just see and understand. What you're looking at right here is a chart that goes all the way back to 1928. Remember the Great Depression, and of course the market crash in 1929 was the worst market crash on the stock side. But here's what my point is, folks. When you go back like this, what this is showing is what the S&P 500 made every year and what the 10-year Treasury bond made every year. And basically it's showing it with 60% in the S&P 500 and 40% in the 10-year Treasury. Now, here's why I'm showing this to you, folks. It's because if you notice 4 years have a yellow box, which is 1931, 1941, 1969, and 2018. Okay, those were the only 4 years up until last year where both the stock market and the bond market ended the year negative. All the other years, in other words, almost 95% of the time, if the stocks ended the year negative, which, negative puts it in pink, then the bonds would end positive. Like, look at 2008, folks. In 2008, you can see where my arrow is. For the calendar year, the S&P 500 was down 37%. But look at that. The 10-year Treasury went up 20%. Holy smoke. But if you notice those 4 yellow box years, both of them ended up negative. That was the only time it happened until 2022. In 2022, it was the 5th time both the stock and bond market ended the year negative together. So it's very rare. And folks, I cannot tell you how many people last year were in my office. These are not necessarily my own clients. They're just new people coming in to talk to us. And a lot of them were upset. They weren't upset with me. They were just mad because they were saying, I don't understand it. Everybody always told me when the stocks go down, the bonds go up. My bonds went down and my stocks went down. And of course, what we showed them is this chart and said, most of the time that's true. When the stocks go down, the bonds go up. But there were 4 years, all the way back to 1928, where both stocks and bonds were down together. And this has happened again. But folks, this is the first time in US history, by the way, that both the stock and the bonds were down more than 10% in the same year. So last year was a brutal year for the stock and bond markets. Now, here's something else, folks. You know, some of you may remember when Lehman Brothers collapsed and the '08 market crash just sort of shocked the world. So people are asking, are we having a Lehman moment in crypto land? Because there was a company called FTX. It was one of the largest and seemingly most legitimate cryptocurrency exchanges in the world, founded by a young man named Sam Bankman-Fried. And here's what the crazy thing, folks. It imploded, went bankrupt, and these FTX tokens, which is basically a convenient way to buy and own cryptocurrency, fell 93%. And you know, this caused major damage in the entire crypto ecosystem, where like Bitcoin fell 75%. And here's the other thing, folks. You know, I don't know if you're aware of this, but about 95% of state and government pensions, you know, like the Illinois pension for the teachers, you know, had cryptocurrency in their portfolio. And 75% of the insurance companies in the United States had cryptocurrency in their portfolio. So we may not fully understand yet what the collapsing cryptocurrency may do to our economy. It's still a little, you know, early to tell. And I'm not saying the pension funds were, you know, half cryptocurrency, but they did have a position of it, you know, in their portfolios. So everybody was getting on the bandwagon, and everybody that had it really got clobbered. Now, here's something else, folks. Interest rates went in 2022 from slightly above zero to 4.3% in less than a year. And we haven't had rates go up that fast, that high since 1980, when Paul Volcker just under Ronald Reagan, aggressively started hiking interest rates as a way to try to break the back of this runaway inflation. So last year we had 7 rate hikes, and we're expected to have another rate hike here in a couple of weeks on February 1st. It'll probably be, you know, 25 basis points. But folks, just so you know, it's been a long time since the Fed has taken this kind of aggressive, they call it tightening when they raise rates like this. And it historically, as I'm going to show you here in a little bit, can cause and has caused, in our view, major damage to the economy, and usually leads to a big slowdown, which can affect the stock market in a big way. And I'm going to show you why. But, you know, but here's something else I want you to be aware of. See, when rates start going up that dramatically, in other words, they basically skyrocketed. I mean, to start at zero and go to 4.3 like that in less than a year, this is the reason why short-term rates, like on T-bills, skyrocketed. In other words, that's why, folks, I don't know if you're aware of this right now. Listen to this. The interest rate on a 3-month T-bill is paying a higher interest rate than the 30-year Treasury bond. Is that crazy or what? In other words, if you want to tie your money up for 30 years, you're going to get about 3.6%, and you're tied up for 30 years. You tied up for 3 months, they'll give you over 4%. And I'm going to get back to that. That's called an inverted yield curve. But here's what my point is, folks. See, when the Fed starts hiking the rates, the short-term rates on T-bills and other short-term types of, fixed income instruments just follow it up. So if you look on my chart, the green line is representing the 90-day T-bill yield. And then, of course, that darker black line represents the discount rate. And so, and I want to say this again, folks, we last year and even now are in the only investment that's making money while interest rates are going up. Everything else got clobbered, and our positions are right now making around 4%. Okay, now I want to show you something else. Now, many of you know this, but when interest rates go up, I always tell people, think of the teeter-totter. It's hard to show you this on my little camera here, but interest rates go up, bond prices go down. Okay, so when they hike interest rates like this, like they haven't done since 1980, bond prices really go down. And so these hiking interest rates really clobbered the bond market. And so now here's what you're looking at here, folks. This is the 10-year Treasury bond going all the way back to 1928, almost going back 100 years. And it's showing the yield on it every year since 1928. Okay, if the box is green, that means it made money. If the box is pink, it means it lost money. And yes, you're looking at it right, folks. 2022, the 10-year Treasury ended the year down a negative 17.8%. You can see it in the lower right-hand part down here. That was the worst drop in the 10-year Treasury bond in history. So if you felt like there was a problem in the bond market last year, there was. And you know what I've been telling our clients, you can thank your lucky stars we got out of the bond market in January of 2022. Now I want to tell you something else. I actually had another slide here, but I was trying to reduce my slides so I wouldn't keep you here all night, folks. But there is another popular bond. It's a bond index called the Barclays Aggregate Bond Index. And you can even buy it as an ETF. The symbol's AGG, they call it the AG. The AG had its worst drop in history. In other words, it had the worst drop it's ever had since 1977, which is when they first came out with the AG. And it was down last year 13%. And the previous worst drop, which was in 1994, it was down a measly negative 2.9%. That was the previous worst drop it ever had since they came out with the index in 1977. Last year, it was down 13%. So that was really bad. And folks, you know what? I don't know about you, but I want to be in a model that can get me out of bonds before they have that kind of collapse. And guess what? That's what you have in our model. Okay, and again, as I always say, in my early life, I worked for a few years for Edward Jones. This is going back in another life. And the head of Edward Jones at that time, his name was John Bachman, and his guy took him from 200 offices to almost 20,000 offices. A brilliant man. He finally retired. But, I always admired the guy. And one of the things he always used to say is this about the stock market: nobody gets out at the top and nobody gets in on the bottom. In other words, we didn't get out at the perfect top, and nobody does, but we sure did better than the typical buy and hold model. Now I want to show you, folks, I want to talk for a moment about, are we in a recession? Because there's still people saying, well, maybe we'll have a soft landing and, won't go into a recession. And folks, in case you don't know now, this is why this is such an important question. Because you know what a recession really is? It's where the economy starts slowing down. And what that really means is businesses their profits start declining. And when their profits start declining, that will make stocks eventually drop every time. And I'm going to show you why later. There's a little concept in our industry called a price earnings ratio, where you look at the price of a stock in relation to its earnings. And so the earnings have to be at a certain level to justify the price. So if those earnings start coming down, that makes the price too expensive. So what happens? The price comes down to be reasonable in light of the amount of earnings that the stock is making, or the amount of money it's making. So right now the price earnings ratios are getting out of whack. And I don't want to get ahead of myself, but this is why it's a big deal to know, are we really going into a recession? Because if we are, and we start having negative earnings, that's going to make the stock market get clobbered. And that's normally what happens in recessions. So first of all, folks, let me say this before I say anything else. You know, if you go back 75 years, I mean, go back to, this is going back to 1947. Every single time we had two negative quarters or more, but at least two negative quarters of GDP, which is gross domestic product, it was always 100% of the time in the last 75 years, they always declared it later to be a recession. The problem is, it's not, you can't really call it a recession until the National Bureau of Economic Research declares it to be one. And if you wait for them, it would be too late to protect yourself. But last year, we did have two negative quarters of gross domestic product. Okay. And so that is why, you know, that is a huge sign that you are in a recession. All right. And also, even though they're still reporting on company earnings, the number one most reliable research firm in the United States for estimating if the earnings are going to be positive or negative for a quarter, because they're trying to figure out if the earnings for the fourth quarter of 2022 are going to end up being positive or negative. But that research firm is FactSet. And FactSet first said, well, the earnings for the fourth quarter are probably going to be a negative. Notice I said negative. That's bad for stocks. A negative 3.2. They came out in the last week and revised it down again and said it's probably going to be a negative 4.6. Well, that, folks, doesn't surprise us. What that means is earnings are starting to come down, which is going to make the stock prices, you know, unjustified at the levels they're at right now. Okay, so I'll come back to that in a little bit. But again, why should stock investors be concerned if you're heading into a recession? Well, let me show you another way to look at it, folks. And I talked about this in the webinar last September, but it bears repeating. But see, it's possible to have, see, a bear market. First of all, what is a bear market? I know most of you know what it is, and some of you are going, Mike, come on, we all know what a bear market is, but there's always that newbie that doesn't know what it is, okay? So a bear market is where the stock market falls 20% or more. Like last year, it fell 24%, so that constituted a bear market. But folks, it is possible to have a bear market without a recession. We've had many bear markets without a recession. But when you have a bear market accompanied by a recession, historically, the market falls further. In other words, it goes deeper and it lasts a lot longer. To give you an example, the last three recessionary bear markets, which was the dot-com crash of 2000, the 08 crash, and the COVID crash of 2020, it averaged, those three market crashes averaged a negative 46.7% drop. So if that average holds true for this current drop, which I don't believe we're done with, that means this stock market has another 30% down to go. Okay, if that average holds up, I don't know. I don't have a crystal ball, folks, but you know, I'm going to show you why we think the market is going to go down more, very likely. Now, here's something else. Again, I showed some of this again last year, but it bears repeating, folks. But I'm showing you right here three of the worst stock market crashes in history. The first one on the left is the 08 crash, which actually started in October of 07. And you can see down in the lower right-hand corner, it ended in actually March of 09. And if you notice in the lower right-hand corner, it shows you the S&P 500 fell 57%. Okay, but now here's the interesting thing. You see those green dots? You see all these green dots here, folks. If you add them up, I believe there's 12 of them. Those green dots represents false rallies. And the red dot, so like, watch this, folks. See, it starts up here, falls to this first red dot, and then everybody's getting spooked. Oh no, the market's going down. Then it starts rallying, and it ran back up 8%. And everybody's going, oh, it's over, thank goodness. I knew it wouldn't last. And then, bam, it falls to the second red dot. And everybody's getting nervous again. Then it runs up 7%. Everybody's going, oh, it's over. And then, bam, it goes to the third red dot. And then it climbed 12%. Bam, it fell to the fourth red dot. And you get the picture. Stock market crashes can just grind on your nerves. And there were 12 green dots, which meant 12 times the market started rebounding. And everybody thought, oh, it's finally over. And then boom, it would go down and more. And that ended up being the second worst stock market crash in the history of the United States. Now go to the middle one, folks. This is the dot-com crash that started in March of 2000. Now the NASDAQ fell more, but I'm looking at the S&P 500 here. And it started in March of 2000. And if you count the green dots, there's 8 of them. This market crash lasted about 2.5 years, believe it or not. And you can see in the lower right-hand corner, you know, it fell about 49%. That's still pretty bad to fall 49%, for Pete's sakes. It basically cut your stocks in half. And notice again, the 8 green dots meant 8 times, I think that's 8 fingers, you had these false rallies. Now, the last one I'm just going to show you tonight, again, I call it the mother of all stock market crashes. This is the one your mama told you about, or maybe your grandma. This is 1929, folks. You know, this is the one where I mean, I wasn't alive then, but I guess they were jumping out of windows. But if you count up the green dots, there's 18 green dots there, folks, which meant there were 18 false rallies. We sometimes call them sucker rallies. And from the top all the way down to the bottom, the market fell 86%. So that means if you had $1 million at the top, when it got to the bottom, your $1 million was worth 140,000. Okay, so the reason I'm showing you this again is a reminder, folks, markets, even if they get worse, never go down in a perfectly straight line. And the way we manage money with especially our 3 buy sell signals on the stock side, folks, we don't chase the stock market. We follow the signals which are showing us if the risk is really high. And I'm telling you, the risk right now is still very high. Okay. And it's not uncommon, especially for I don't want to sound demeaning to small investors. I consider myself one also, but it's usually the small investors that really are not that understand what's going on under the hood, that are just chasing the market like this. Now, here's something else I want to show you, folks, that leads us to believe we're in a recession. In the past 50 years, every time the Fed responded to periods of high inflation by raising the interest rates, a recession happened every time in the last 50 years. And if you look on here, you can see the red line is inflation. You know, that's the consumer price index. And you can see every time that red line, which is inflation, would go up, the blue line would follow, because the Fed starts hiking interest rates to kill the inflation. And those vertical gray bars are recessions. So you notice the red bar goes up, then they hike the interest rates, which is the blue bar, and then you see the gray bar, which is the recession. Now, here we are, look all the way over to the right. Now, the interest rate started basically at 0, and they cranked them up to 4.3. That may not sound like a lot, folks. That was huge to do that. And then you can see the red line was inflation, which peaked last year at 9.1%. It did come down to about 6.5%, but they started cranking rates. Now, is this going to be the first time that they, cranked rates to stop inflation, that, we're not going to go into a recession? All the other times we did, but this time it's going to be different. I don't think so, folks. Now, here's something else that leads us to believe we're in a recession. And, folks, again, I got to tell you, I had a lot of slides I took out of this seminar. And some of you go, yep, that's Mike. All right. He does long meetings. And you wouldn't believe how many slides I pulled out here. I thought, this is getting too granular. I always ask some of my staff, like especially Ben and Matt, and they said, take some of them out, Mike, that's too many. But here's my point, folks. There is a lot of data out there that are flashing warning signs of going into a recession. But this is a huge one right here. What you're looking at, this chart is from the Conference Board of Leading Economic Indicators, and it's considered the guru of recession foresight. In other words, forecasting a recession. And their indicator is comprised of 10 what they call forward-looking measurements, all with good track records of seeing oncoming recessions. And all 10 of these indicators are rolled into one that they call the Conference Board Leading Economic Indicator. And each one uses a different methodology. Actually, I have the list of all 10 of them here. I promise I'm not going to read all of them, but like they'll look at the volume of manufacturers' new orders for consumer goods and materials. They'll look at the number of new building permits for residential buildings. You see why I don't want to read all of that stuff, folks. But I'm just telling you, this is a really reliable indicator. And if you notice it, notice every time that they call it the LEI index for short. Look at the chart, folks, all the way back to 1959. And you see every time it had a major downturn, you see those gray bars, those are recessions. Now, look where it is today. And I kind of blew it up in this little box so you can see it the last 12 months. It has been in a downturn for 10 consecutive months in a row now, folks. And it's, the last one was in December, and we'll get the reading this year, but we know it's going to decline again. And in fact, all the way back to 1959, any decline in the LEI index of this magnitude that we're experiencing right now has always led to a recession, okay? Or they concluded, oh, we're in a recession. Okay, now here's something else, folks, that I want to point out to you. Because of all these prices going up last year, even food prices are still going up. We had some things decline, like used cars. Okay, they declined. Even house prices have come down a little bit, not a lot. But because of inflation, rising prices last year, what happened, saving rates dropped to near record lows in 2022. And you can see on the chart, when they started, remember when we all had to stay home, so nobody could spend any money. Plus, they were giving out those stimulus checks. You can see the 3 stimulus checks they gave out. And while they were doing that, the savings rate for the average American citizen went up because they were, had this money and they couldn't spend it. And then all of a sudden, the reason the savings rate has dropped to the lowest since 2005 is because people now, nobody's got any money because people are using up all their savings to pay for these expensive goods and services that have all really gone up the last year. Now, you want me to show you something else that's going on, folks. Because of the rising prices, in other words, inflation, borrowing levels on credit cards are just going to the highest levels we've seen since 2011. And again, people are borrowing just to pay their bills because of the way prices are going up. Now, if you're a retiree, you may not fathom how people are doing this kind of thing, but folks, you're looking at a graph that's showing this. In other words, this is what I'm getting at. Savings are dwindling, and people are maxing out their credit cards. And these two things very well may cause a drop in retail sales. And folks, the consumer makes up 2/3 of gross domestic product. If they stop spending, that is a major factor that can cause the economy to shrink. Okay. And by the way, some of you may know this, but U.S. retail sales, this was in the Wall Street Journal. This is one of the slides I took out. They fell 1.1% in December. I'm talking about last month. And so it was the sharpest drop of all of last year. And it happened in December when everybody's supposed to be out shopping for Christmas. So it was kind of a negative end of the holiday season. And the reason the retail sales fell like that, folks, is because of the rising interest rates, the still very high inflation, and concerns about the slowing economy just pinched the average American consumer. Now, if you want me to tell you something else, folks, by the way, the national debt, this is the money our government owes, just crossed $30 trillion. And just to put that in perspective, in the year 2000, the national debt was 6 trillion in the year 2000. Well, here we are in 2023, it just crossed $30 trillion, folks. Now, again, you may not fathom what this number means, but also because of the way the short-term interest rates just skyrocketed, did you know that the interest on that national debt just crossed $766 billion? In other words, the expense that our government has to pay on the national debt, which is they're the biggest debtor in the world, but that $766 billion interest they got to pay on the national debt is almost approaching the level of what the government pays for Social Security. I mean, so, that's a subject for another workshop, folks, but I thought I'd mention that to you. Now, what's been going on in the housing market? Well, let me just show you something that just happened, folks. Since January 1st, we're still in January, but the traffic of prospective buyers index from the National Association of Home Builders has collapsed since January 1st. Now, keep in mind, what is today? January 26th. In other words, this drop in the traffic of prospective buyers, in other words, the people interested in buying a house, has dropped this drop is almost twice as large as the decline in the 05-06 time period, when the previous housing bubble started to deflate. Okay, so this is an ominous sign. In other words, these kind of declines in this leading housing indicator have characteristically accompanied or led into a recession, just like it did when the housing bubble burst, starting in 05. I'll show you something else, folks. Do you know, if you go all the way back, believe it or not, to 1891 and adjust the average price of a house in the United States, and you adjust it for inflation, it's up about 140% adjusted for inflation all the way back to 1891. But from the start of 2020, which was the COVID year, to the peak, which was in June of 2022, house prices rose 45% nationally. And the inflation adjusted house price exceeded the housing bubble that started in the mid 2000s. What I'm telling you, folks, house prices, even though they've come down a little bit, are right now still at an all-time high. But here's the thing that is scary along with that. And that is, when we started 2022, mortgage interest rates, it's hard to believe, were below 3%. And then they skyrocketed, where last year for a while, they were above 7%. Now they dropped a little bit to a little under 6.5%, but they're still at the highest level we've seen since, about 2002. And this is why that's a problem, folks. You got a combination of skyrocketing home prices and skyrocketing mortgage rates that is starting to make housing unaffordable for many families. And here's a way to look at it, folks. The average house payment right now, you can see it up here. You see that 46.3%? What that's showing you is the average house payment right now represents 46% of a family's income, where 2 years ago, it represented about 29% of a family's income. So in other words, folks, you're not supposed to pay half of your income for your house payment every month, right? So this combination of skyrocketing house prices and skyrocketing mortgage rates is starting to make housing unaffordable. And this lack of affordability can also lead to an economic slowdown and defaults, just like it did when the housing bubble burst starting in '05. Now these are, folks, I'm just showing you, I'm leading up to showing you something, okay? But I'm just simply saying, no matter what you see the market doing from day to day, because a lot of times that can be based on emotion, there is still a lot of risk out there. And here's something else I want to show you. You know, we talked about this index before. This is the consumer index. I'm sorry, consumer sentiment index put out by the University of Michigan. Most analysts, stock analysts, follow this index because when the consumer starts getting very negative on their outlook on the economy, it's always been a great predictor of an economic slowdown, because when the consumer starts getting negative, they stop spending, okay? So this index hit an all-time low last year and now has been 8 consecutive months in a row below 60. You can see the red line there, and that's the longest run of what they call extreme negative consumer sentiment ever seen ever since they started publishing this data in 1952. The previous record was 4 straight months below 60, and that was in the 1980s. Well, now we've had 8 straight months with what we call extreme consumer sentiment. Okay, so that's something else that we're watching that indicates we are in a recession or heading that way. And of course, I'm sure most of you have heard of this huge warning signal for a recession, which is called an inverted yield curve. And folks, again, I don't want to spend a lot of time on this. I know most of you know what this means, but I always have new people that say, well, no, Mike, I don't know what that means. So I'm going to briefly explain it. But an inverted yield curve, historically, they look at the 10-year Treasury bond and the 2-year Treasury bond. And the way I tell people to think about it, think of a 2-year CD at a bank and a 10-year CD, and there's a few of those 10-year CDs out there. If I bought a 10-year CD, I'd expect to get a better interest rate on a 10-year CD than on a 2-year CD, right? Because I'm locking my money up for 10 years. But every once in a while that flips, where all of a sudden the 2-year CD's got a better interest rate than the 10-year CD, and they call that an inverted yield curve. Except instead of looking at CDs, what the government looks at are Treasury bonds, but it's the same principle. So right now, you've got the 2-year Treasury bond paying a better interest rate than the 10-year, and they call that an inverted yield curve. And the more inverted it is, the wider the gap, the more ominous it is. It's the bond market's way of saying, hey, buddy, this is our warning that you are heading towards a real slowdown. And this is the most inverted it's been since the early 1980s, folks. And this is, again, I want to tell you, when it's been inverted at this level, it's always preceded, what we call an economic recession. And by the way, it's not just the two-year versus the 10-year. It's all along the spectrum, folks. I told you earlier, right now, the 3-month is Treasury bills paying higher interest rate than the 30-year Treasury bond. So this is a huge warning flag that you're going into a recession. Now, something else I want to mention to you, folks, because, again, lately people have been looking at inflation coming down, and the media doesn't help, because a lot of times the media is always trying to sell news and they try to keep the top spinning. But many people just assume, oh, inflation's coming down, so that means, things are getting better. The stock market's probably going to go up. Everything's getting rosy. Well, but folks, let me tell you about another inflation index that's not as well known, but as the consumer price index, the CPI index, or the core CPI index. This lesser known index is called the Sticky Price Consumer Price Index. You can Google it and it'll pop right up, but they call it the Sticky Price Consumer Price Index. And so before I explain it, let me say this. I do believe inflation probably did peak. I mean, CPI inflation last year at 9.1. However, there are far more important contributors to inflation than some of the things in the normal CPI index. And what I'm talking about are what they call sticky prices like wages and rent. In other words, if you give somebody a pay increase, it's hard to take it back, right? If you raise the rent, it's hard to go in and lower it again. So those are the kind of items that once you raise them, they remain resilient, or they call the term sticky, and it'll take far longer and require more economic pain to start lowering sticky price inflation. So listen to this, folks. Even though the CPI index, that's the popular one that everybody looks at, look at inflation, it came down, and the core CPI inflation index came down. The sticky price CPI index didn't come down at all. In fact, it went up last month. And right now you can see it on my chart. It's at the highest level in 39 years. It's a little under 6.5%. Now, why am I saying this, folks? The first maybe, 2.5 or 3% of pulling inflation down is a little easier than that last 5 or 6% where you're getting into these sticky items that's harder to bring them down. And here's why that's so important. The Fed's target is to get this inflation down to 2%. And they're still, if sticky price inflation is above 6, they still got a long way to go to pull it down to 6%. And that's why the Fed may not do the pivot as quick as people think. Say, oh, the Fed's going to find, go, okay, boys, all right, we're going to stop raising rates. In fact, we'll start lowering them. Folks, we think this may take longer than, the public thinks, or many people in the public think, to get it, before they stop being more aggressive as far as hiking rates, and certainly before they start lowering rates again. Now, let me talk about something here that I call false assumptions. These are things people just popularly believe that simply do not bear out historically to be true. One of the things people believe is low unemployment means there's no recession. Like right now, people are coming in saying to me, hey, Mike, we got a good, solid, low unemployment, it's like whatever it is, 3.7, one of the lowest unemployment rates in history. Isn't that bode well for the economy being really strong? Well, doesn't that mean the market will probably go up? Well, folks, let me tell you, I'm going to tell you my unofficial version, then I want to tell you something about historically what happens. But one thing I want you to understand, do you realize our government, if somebody goes 6 weeks without looking for a job, then they stop recognizing you as unemployed. Did you know that? So do you realize there's a far more reliable way to see how many people are really working? And that's to look at something you don't hear about in the news as much, called the labor participation rate. If you just Google it, it'll pop right up and explain it. But what that means, what the labor participation rate means, is what percent of our population is in the labor force, between 15 and 65. It's what percent of our adult population is working. Well, the labor participation rate, especially since COVID, is at one of the lowest percents it's ever been at in history, which means there's a lot of people that are not working, and they're not counting them as unemployed because they haven't looked for a job for 6 weeks. That's how our government calculates these things, folks. So in other words, the real unemployment is probably a lot worse than we think it is, but let's just use the 3.7. Anyway, well, listen to this, folks. People say, well, with this kind of low unemployment, the economy's got to be strong. Well, this is the thing to understand, folks. Unemployment is not a leading economic indicator. In other words, it doesn't rise before a recession. In other words, unemployment doesn't rise before a recession, but instead it rises during the recession. I'll give you an example. In the dot-com crash, or I'll call it the dot-com recession, it officially started in March of 2001, and the last unemployment reading the month before, which would have been February of 2001, the unemployment rate was 4.2%. By the end of the recession in November of '01, the unemployment had climbed to almost 6%. Okay, now in the 2008 recession, okay, the great financial crisis recession in '08, the recession officially started in December of '07. Okay, so the last unemployment reading the month before, which was November of '07, the unemployment rate was 4.7%. By the end of the recession in June of '09, the unemployment rate climbed to 9.5%. But at the beginning of the recession, it was real low. And finally, in the COVID recession, which started in February of 2020, the last unemployment reading, but the recession started in February. So the last unemployment reading the month before, which was January of 2020, unemployment was at 3.5%. By the end of the recession in April of 2020, the unemployment climbed to 14.7%. So what am I telling you, folks? Unemployment doesn't rise before a recession, it rises during a recession. So now here's the other thing people believe. They say, oh, if inflation peaks, doesn't that signal that you're somehow at a market bottom and the stocks are going to take off? Well, let's just look. Let's see if I can get my slide to move. Listen to this, folks. During the dot-com crash, that was started March of 2000. Inflation peaked in June of 2000. Okay, that's where it peaked, June of 2000. But the eventual market bottom ended in October of 2002, over 2 years after inflation peaked. And from the date inflation peaked in June of 2000, the market fell 46.15% from that inflation peak. Little scary. Now, during the great financial crisis bear market of '08, inflation peaked in July of '08, but the eventual market bottom was on March 9th of '09, 7 months later. And from where the inflation peaked in July, when the stock market hit the bottom, from where the inflation peaked, it fell another 46.62% from where inflation peaked. So, folks, what's the moral of the story here? History shows that from where inflation peaked doesn't mean you're anywhere near a market bottom. Now, let me show you another one people are saying. They're saying, well, when the Fed finally stops hiking rates, when they do that last rate hike, maybe it'll be February 1st. Don't count on it, folks. But let's say wherever that final rate hike is, that's where the stock market will take off. Okay, so I want to show you something. As you can see by my chart, history shows a less optimistic reality, folks. So here's what you're looking at. This chart goes all the way back to 1929, showing you the date of the final rate hike in several interest rate cycles, where they were hiking rates. So look at this first one. They did 4 rate hikes, and the last one was August 9th of 1929. And after that last rate hike, look all the way over in the last column, folks, the stock market fell another 84.5% after the last rate hike. Now, I don't want to go through all of these, folks, but here's what the point is. Out of those 16 rate hike cycles, 8 of those 16 historical instances resulted in a maximum loss of more than 20% in the stock market after the final rate hike. 2 of the past 3 final rate hikes, you can see them down here on the bottom. 2 of the last 3 final rate hikes were followed by a maximum loss of nearly 50% in the stock market after the Fed made the last rate hike. And what I'm telling you, on average, when it comes to interest rate cycles that occur in bear markets, the majority of the stock market losses still lie ahead after the final rate hike. Okay, so we're not out of the woods just because the Fed stops hiking rates. And folks, let me take this one step further. Even if the Fed, let's say, did a full policy pivot, you've been hearing the term the Fed pivot, where old Jerome Powell's going to say, okay, not only am I going to stop hiking rates, by golly, we're going to start lowering the rates. Well, a prime example where they did this, folks, was in the 2007-2008 market crash, better known as the '08 crash. Now, if you look at this chart, you can see that the Fed started cutting rates in August of '07. Now, the market peaked and reached its highest level in October of '07. That's where the crash began. So the Fed started hiking rates in August of '07, hiked them all the way to December of '08, basically hiked them through the market crash, cut the rates 11 times, and bringing rates down to the lowest level in history at that time. And despite these efforts of lowering the rates 11 times, the S&P 500 ended up with the largest bear market crash since the Great Depression. So even if the Fed did a full pivot, folks, what I'm telling you is when the Fed starts hiking rates like this and the economy starts cooling down and going, negative, there is a lagging effect where the damage starts piling up after the rate hikes. Okay, so I'm not trying to be negative here, but I'm just showing you some reality. So now I want to talk about S&P 500 earnings declines. And folks, let me tell you something. So, I've got people on this Zoom meeting that you've been my clients for a quarter of a century or more. And some you say, Mike always used to tell me, even back when he was a young man, I'm still a young man for Pete's sake, but they say when he was a young man, he used to always tell me the number one thing that'll drive the stocks down is if their earnings decline. You know what earnings is, folks? That's a fancy word for profits. So it's just common sense. If the company becomes less profitable, then their stock becomes less valuable and it's going to start coming down. And there's a way they can measure that mathematically called a price earnings ratio, which I'm going to get to. But here's the thing I just want to say for right now. The fourth quarter of 2022 earnings season for the S&P 500, they always look at the 500 stocks that make up the S&P 500 as kind of a barometer for what the whole country is doing, and it did not start off on a strong start. And the earnings decline for the fourth quarter is larger today compared to what they thought it was going to be just a week ago, folks. So the fourth quarter 2022 earnings, with about 15% of the companies reporting, I don't know how they do it, but these analysts still get it really, really close at this point. But they're estimating the earnings for the fourth quarter are going to decline by 4.6%. Now, if this 4.6% negative decline in earnings for the fourth quarter of 2022 is the actual decline, it will mark the first time this index has reported a year-over-year decline in earnings since the quarter three of the 2020 COVID year, where it declined to negative 5.7. But that was COVID that shut the whole country down. In other words, this is a really serious decline, folks. And also, just a few months ago, they were saying, we're going to have earnings grow in the first and second quarter of 2023. Now they're predicting earnings are going to decline in the first and second quarter of 2023. And of course, that they're still kind of figuring out exactly how much. And but this is a significant thing to understand. Now, let me show you something here, folks, and why I'm telling you this. Okay, now, I know many of you probably know what a price earnings ratio is, or at least you've heard of it, okay? But here's a way to think about it, because I'm leading up to showing you something. So for some of you are going, oh no, this is math. Math was not my favorite subject in school. Trust me, this is simple math, okay? And my engineers out there are chuckling and my accountants are chuckling, but this is a way to think about it, folks. Let's say I have a stock, a share of a stock, and it's ABC stock, and the price of my share is $100. That's what it's trading at. And the earnings per share is $10. And how they get the earnings per share, folks, you know what they do? They look at the profit for the whole company and divide it by the number of shares of stock and come up with the earnings or profit for each share of stock. Okay, so let's say the price of the stock by ABC stock is $100 a share, and the earnings that stock is earning, the earnings per share is $10. Okay, so here's how they come up with a PE ratio, price earnings ratio. They take the price, which in my example is $100, and divide it by the earnings, which is $10. And guess what? You take $100 divided by $10, and guess what you get? 20. So 20 is the PE ratio. And some of you, so that's great, Mike. What the heck does that mean? Okay, so if the PE ratio is 20, here's what it means, folks. It means for every $20 I put in that stock, I'm getting $1 of earnings. And some of you are still saying, so what? So, okay, so what does that mean? Okay, so what that means is if all of a sudden that company has earning declines because everything's slowing down, the economy's slowing down, we're going into a recession, and that company's not making as much money, so their profits or earnings start declining because all the consumers stop buying. So let's say those earnings per share dropped from $10 to now wait a minute. I did I say 10? You know what? Folks, I just screwed up my example because $10 would not give me a PE of 20. I'm sorry. Sorry, guys. Let me say the stock is at $100 and the earnings are $5. And I'm sorry, I apologize, because it'll be easy. So if the stock is $10, if the stock is $100 and the earnings are $5, not $10, that would give me a PE ratio of 20. So somebody go, man, Mike, I thought you were a math guy. I am, but so $100 divided by $5 earnings. In other words, that's a price earnings ratio. The price is $100 of the stock. The earnings are $5. $100 divided by $5 of earnings, which is a lot more reasonable, by the way, gives me a PE ratio of 20. So that means for every $20 I put in that stock, I'm getting $1 of earnings. Now the earnings decline from $5 a share to only $2.50 a share. So $100 a share divided by $2.50, guess what that gives me? A PE ratio of 40. Whoa. So that means every time I buy that stock, I'm paying $40 for a dollar's worth of earnings. So then you got to know, well, what's a reasonable PE ratio? Well, believe it or not, folks, it's 15. 20 is high. 40 is outrageously high. So in other words, what I'm telling you is if my stock is trading at $100 and my earnings per share are $5, I've got a PE ratio of 20. That's a little high, but that's probably okay. By the way, the PE ratio right now, the S&P 500 is around 20, which is a little higher than its historical average, which is 15. Okay, but 20 is a little high, but maybe okay. But if the price of those earnings drop to $2.50 in my example, from $5 to $2.50, and the price of the stock is still at 100, that makes the PE ratio 40. So everybody out there that's really smart is going to go, now, wait a minute. I'm not going to pay $40 for a dollar's worth of earnings. No way am I going to do that. So guess what? The price of that stock has got to come down until the price makes the $2.50 of earnings become a PE ratio of 20 again. So what that price has got to do is drop from $100 to $50. Because if you take, and I hope I'm doing this right, folks, this late at night, maybe I better check myself. So if the price of the stock drops to 50 and the earnings are $2.50, 50 divided by $2.50 of earnings gets me back to 20 again. Hooray. The problem is my stock just got cut in half to make the PE ratio get back to 20. Now, folks, I know some of you are going, Mike, this is too much, but I'm just trying to explain to you, if these earnings start going down, folks, it's going to make these PE ratios go unsustainably high, and the smart investors aren't going to pay $40 for a dollar's worth of earnings. And the market knows that, so the market's going to start coming down. Now, let me show you what you're looking at here, folks. This is giving you an estimate of where the S&P 500 should be in a recession and a non-recession scenario. Now, just Now watch this, folks, because you can get the PE ratio of the S&P 500. And now here's a way to think about it. I don't know exactly where the S&P closed today. It was a little above 4,000. It's a number that they use to show you the S&P 500. But I know yesterday it closed at 4,016. Okay. So the way they do this, these analysts will calculate the earnings for the whole S&P 500 index. And some of those analysts right now have calculated that the earnings for 2023 for the S&P 500 are going to be $205 a share. Okay, I think that's high, by the way, but some think they're going to be higher than that. I just read one analyst saying it's probably going to be $200 a share. So here's a simple way to think about it, folks. If I say the S&P closed today at 4,000, it was actually higher, slightly higher than that, but let's say it was 4,000 divided by $205 of earnings gives me a PE ratio of 19.5, almost 20, which is a little high. Okay, so if the earnings are $205 and the S&P 500 right now, and you just look at the S&P 500, you can see the price today, that would give me a PE ratio of 19.5. Okay, now here's what I'm showing you, folks. With no recession, if the PE ratio just goes down to 17 and its long-term average is 15, right now it's at 19.5. If it goes just down, the PE ratio just goes down to 17, and the earnings for 2023 turn out to be $205 a share, guess what that's going to put the S&P 500 at to make that happen? It's going to drop from 4,000 to 3,485, which means it's going to fall 12.5% to get to a PE ratio of 17, which is still high if the earnings are $205 a share this year, which I don't think they're going to be. I think they're going to be lower, which would make the drop even bigger. Now, watch this, folks. A soft landing recession, assuming the earnings this year are going to be $205 for the S&P 500, and the PE ratio goes to 15, which is its long-term average, guess what that's going to put the S&P 500 at? You can see it over here on the left, 3,075 down from roughly 4,000. That means the S&P 500 would have to go down 23%. Now, let's say that the earnings decline to 160 per share, which I think is possible, depending on how bad this recession gets. This is what the smart people are worrying about, folks. There's, a lot of the analysts are chattering about this. If the earnings go down to 160 a share for the S&P 500, and the PE ratio goes to 15, and usually in a recession, the PE ratios will go down closer to their long-term average of 15. Okay, so if the earnings turn out to be $160 for the S&P 500 for this year, and the PE ratio goes to 15, that means the S&P 500 would have to go to 2,400, which means it would drop from where we're at today another 40%. Okay, now I don't know where it's going to drop, folks, but I am just pointing out to you, this is why a lot of the analysts and big money managers are worried about this being a recession, because if it's a recession, you're going to have earnings declines. That's what a recession is all about, because of the economy contracting, and there's a lot of signs that we're heading toward it. I didn't even tell you about the Purchasing Managers Index, the PMI index. They have one for manufacturing, one for the service industry. They are, if they're above, those two numbers are above 50, that means manufacturing and the service industry are expanding. If they're below 50, which they both are, that means they're contracting or the economy is shrinking. But so I'm just simply showing you, folks, no matter what we think or what we're looking at here, by the way, we still follow our buy-sell signals, and you never know, but, and there are times like in 08, some of our signals did go positive for a while and went back into the market, made a little money and came back out. It doesn't work 100%, but it tends to work a lot more than it doesn't. But I am just telling you, our signals are warning us there is still a lot of risk out there, especially on the stock side. Okay, so let me tell you what I see as a likely scenario, folks. Um, see, I believe the next wave of the bear market is where you're going to start seeing panic selling, uh, where people will start selling out at any price. And what's going to cause it, I believe, is worry as these stock analysts start lowering their earnings estimates because of the fallout from the aggressive rate hikes. And I would not be surprised to see the stocks drop significantly over the next few months, possibly even in the next quarter. And guess what, folks? We're going to be in a good position being out of the market to take advantage of what could be an incredible buying opportunity. And I'll also say this, some of you have been in my office, I've told you this, I know Matt's told you this, and Ben's told you this. We think the bonds may be closer to the bottom than the stocks, and maybe they may present the first buying opportunity, which we believe the bonds could, actually be getting near their bottom this quarter. And we are currently 100% in T-bills through an ETF that is 100% in T-bills, and a government money market that is mostly also in short-term T-bills, paying 4% as we're waiting for these opportunities. So we see a double buying opportunity coming up for us, folks. And again, I'm saying this, last year will go down in some ways as record-breaking in not such a good way. Again, one of the worst drops for a 60-40 model in history, the worst drop in bonds in history. Last year will go down as a classic, folks. And that was a year where we were in protect mode. We don't see that this year. And I want to say this again, you are in a model where we're not just in T-bills, folks, you're in a dynamic process where we have our finger on the trigger, and we can pull that trigger anytime in the next few days or next few weeks or the next few months, maybe on the stock side, where we're going to go back in near the bottom. And I want to give a point, folks. As an example, the ag index dropped 13% last year. If you drop 13%, to get back to zero, you got to make 15%. In other words, if we go back in to bonds near the bottom and they just go up 10%, we're going to make money, but they won't even be back to zero yet. They got to make 15% to get back to zero, but we're not going to have that problem because we didn't go down on the bond side because we stepped out of bonds in January. So we have a very unusual opportunity we don't normally get on the bond sides, because normally in the years the stocks go down, the bonds go up, and we don't have this opportunity. Like in 2008, the stocks went down 37% for the calendar year, and the bonds went up 20%. So here we have a very unusual opportunity. It's only happened 5 years in the last 100 years, folks, about 5% of the time, where we see a double opportunity, not just to make money on the stock side, but on the bond side. So I want to encourage you, be patient, okay? And, because we have our finger on the trigger and we see some opportunities coming up, and we are predicting the bond side is going to happen sooner than the stock side. It could happen fairly soon, but we'll see. We're watching that signal. Now, some of you, by the way, are asking this question. You're saying, well, Mike, I've got money with you, but I have money with my other guy, and that money just got clobbered. So I'd like to put it in your model and take advantage of some of this, but is it too late to get out? And for those of you that had all your money with us last year, you couldn't be in a better place than you're in right now. But again, some of you, as I just said, have money with some of these other firms. And what are they telling you right now? Stay in no matter what. You hear the same tune over and over again. Stay in, stay in, stay in. Ride it all the way down to the bottom. And folks, the S&P 500 was down last year as much as 24%. End of the year down basically 20%. It's come back a little bit. And because of that, because it's bounced back up, you have an opportunity to exit the market, especially if you think it's going to get worse like we do. And again, folks, I want to remind you of the last three recessionary bear markets, which was the dot-com crash in 2000, the '08 crash, and the COVID crash. The market averaged falling a negative 47%. If that happens again, we have about another 30% to go on the stock side. And if we're wrong, which isn't likely, our signals will turn green and we'll get back in. And once all three signals turn green, we go 100% stock on. For some of you, we go 120% stock. And even if we're a little behind, we catch up very rapidly by doing that. But we only do that when we get the all clear, and that's nowhere near happening right now, folks. So again, I actually am ending, my September one lasted an hour and a half, folks. So this is a record for me. And so I am going to quit here in a minute, folks. And I hope you did enjoy this and find it helpful. I just want you to understand, because there's a lot of noise out there, and we have some of the top research partners in the country, the people that call it right, including our own researcher who, we have a model with a proven history of reducing stock before catastrophic drops. And we don't even think the catastrophic part may have happened yet on the stock side, believe it or not. So if you do have questions, folks, I'll look forward to talking to you in your review. You can also call the office tomorrow. And also, folks, I do want to remind you, if you got something in the mail on our client ambassador program, if you turn to the back of it, on the very back, there's a little barcode. And you know how you put your phone on the barcode in the restaurant and you can see the restaurant menu? If you put your phone on that barcode, it'll explain how you can become a client ambassador. And if you do become one, we're going to have a real nice dinner later on in the year. And, my marketing person, Nolene, you can call her. She can tell you more about it. It's a great program and a great way if you have a friend or relative that you care about them or worried about them if they're in the market, where you can refer them over to us. And whether they become a client or not, it doesn't matter. You're still a client ambassador, and can still participate in our fun activities coming up. So anyway, folks, all right, I'm going to quit. And I appreciate you staying with me tonight. And again, I look forward to seeing you when you come in. If you have questions, please feel free to give us a call. So with that, good night and God bless you.